So what do all these figures say about the retail environment now? Well, for insight, we're joined by someone who specializes and invests specifically in this sector. It's David Berman. He's a hedge fund manager and founder of Durban Capital. He's with me here now on set. The last time you were here, David, you said this was an environment of retail nirvana. Forget double-digit unemployment. You thought the environment was actually good for retailers. Yeah. We got results today. What does this say to you now?
Well, we spoke about retail nirvana a few months ago, and I think this just proves it, that we're in retail nirvana. It wasn't just, our thesis wasn't just about great top line, although we felt that that would improve because of the easier comparisons. The primary thesis about retail nirvana is because operating margins are essentially going through the roof for this type of environment, for two primary reasons. And it's exactly what we're seeing in these numbers now, Margaret.
Mm-hmm. So today's numbers, and I believe we have a chart here of an index that your firm put together, DB Index, aggregating basically all the sales. What we learned today from the nation's biggest stores about what happened this season. You had said in September you're expecting maybe 0.5% growth out of the holiday season. Look at this chart now. We're up nearly 5%. Results?
Well, this chart is actually same-store sales.
Right.
So what I was talking about before, up 0.5% to 1% was total sales.
Right.
So that this is just same-store sales. Only part.
Does this, what we saw today, though, change that forecast?
No, I'd say we were pretty close. Okay. It's hard to know what the total number will be. Maybe it'll be a little bit higher than 0.5% to 1%. It's unclear because that's the total sales for all retailers. Mm-hmm. The NRF at that time were down 1%. So they've kind of come more in line with what we were saying 2 or 3 months ago. What has improved, is the same-store sales. The chart that you just put up, is that the same-store sales for this month, according to our DB Index, was up 4.7%. Wow. Same-store sales.
And now, that's excluding Walmart, though.
That's correct.
The giant.
That's correct. But if you exclude foreign exchange and gas, which we should, because Costco and TJ Maxx, for example, benefit a lot by that, then same-store sales were only up 2.5%. Nonetheless, it's still about the best same-store sale increase we've seen in 3 years.
Much is being made today because we're seeing consumer discretionary experiencing some gains in today's market. A lot has been said that, forecasts were low. It looks like most retailers beat them. I mean, should we still be thinking that perhaps there's a comeback here in the retail space? Is this about the consumer, or is this about something else?
Well, I think this is more about the consumer than something else, because analysts have had all year to raise numbers. Mm-hmm. Retailers started beating numbers, in the first and second quarter, and they kept on raising numbers, but they're still going even higher and higher. So in a sense, when I say retail nirvana, the numbers that were reported today were even better than the sort of increased expectations that analysts had throughout the month. I mean, you're seeing stocks that you mentioned earlier, Sears, Nordstrom's, knocking the cover off the ball, where sales were slightly better, but earnings were way better than expected.
When you're starting at zero, though, when you have a Christmas as tough as we did last year, you could look at any kind of improvement and say, wow, we need to breathe a sign of relief. Put this in context, though. I know you've been doing some work year over year looking at the percentage of sales and the growth rate. Give us some context to just how meaningful these gains are.
Well, to put it in perspective, okay, yes, are we up against easier comparisons, as you say? Absolutely. So, but nonetheless, to get a 4.7% same-store sale, or even ex-gas and Forex to get a 2.5% same-store sale, when you look at the trend line from what it was before, even looking at November, October, and the months before, it is still stronger than that. What really surprises me, it actually even exceeded my expectations for the month of December, because the inventories are so low. In fact, according to our inventory model, all retailers reported inventories and sales for the quarter at the end of October. Okay?
And I believe we have a chart of this, of some of the work that you've been doing with inventories here, because inventories are so key. And we know that retailers ended up last Christmas with way too much stuff in their stores.
That's correct.
They pulled back very sharply.
That's correct.
And look at this now. Tell me what this work signifies.
Well, this chart goes back about 10 years, and it looks at the sales growth rate versus the earnings growth rate, because obviously retail is seasonal, so you need to compare it year over year. And then it compares the sales growth rate to the earnings growth rate. And if you have a look at that chart, you'll see that it starts to get better, which means that, for example, in the last quarter that's just reported, total sales in the U.S. economy were flat. Total inventories were down 4%. 3 or 4%.
Wow.
That 3 or 4% spread is a really powerful spread.
So less in the store than almost they needed to sell.
That's correct. So the question is, how are you going to get those sales, some people are saying, if you don't even have the inventories?
We're back here in our New York headquarters with David Berman, hedge fund manager and founder of Durban Capital, who was running us through basically what he takes away as the bottom line from today's holiday sales figures that we got from the nation's biggest stores in this country. David, a big part of this, as you were saying, is inventory control. Essentially, retailers learned the lesson of last year, had less on their shelves, basically, than they needed. But it brings us back to that question of margins. Last year, they were hit really hard, forced markdowns. This year, though, you point out, retailers have tremendous cash on hand. If your retail Nirvana thesis plays out, basically, they don't have to cut
Absolutely
costs.
right. In fact, if you look at the chart that you've just put up, you'll see that the third quarter, which was just reported, is the blue line, and you'll see that operating margins for the first time started to climb after the last number of years of decline. So we think the worst has been hit. Now, if you look at the chart, you'll see that it wasn't even as bad as 2001. So the retailers, through this recession, went through an unusually good period where they were really, really quick at getting rid of inventories, and which is why last year you saw bad margins, bad numbers, and everything like that. But the unbelievable thing is that 88%, according to our numbers, 88% of retailers have more net cash at the end of the third quarter than they had the year before. And that's having gone through one of the worst sort of generational recessions obviously in our lifetime. So you know,
they cut pretty deeply, is what that says.
They cut
internally.
capex, they cut store growth, they cut inventories, and they did such a good job of it in unison that it's actually raised, and particularly Walmart, it's raised the gross margins for everybody. And they cut SG&A, so that raised operating margins even further.
But it's not a perfect world out there. Maybe retail Nirvana, but there are still stores that are struggling. Food, in particular, it has
That's
been
correct.
A big
Supermarkets are a bit of an issue. Supermarket stocks are struggling as a result because there's actually been deflation, and deflation is not good, particularly for supermarkets. It can be good in retail. In fact, it actually is good for retail right now because what's happening, remarkably, is that the companies are buying cheaper from overseas in a lot of cases, sometimes about as much as 10%, but they're not passing along those savings to the consumer in unison. So as a result of the buying better, they're all showing this great gross margin expansion. Everybody thinks it's coming from inventory control, which it is in part. There's no question about it. But a lot of it, if not most of it, it's unclear, is coming from better buying.
But when you're talking about that, in mixing food and apparel, or food and other products, there are only a few players that have both under their roof, right? So you're talking about Walmart and Target,
aren't
you?
That's right, but mainly Walmart, because Walmart's got a lot more, in terms of food than Target does. Target's got a lot more apparel. But with Walmart, the issue is that the deflation with food happens much quicker. The turns are much faster. So what happens is if the price of orange juice goes down, you kind of almost have to sell it at a low price the next day. There's no time to sort of have that sort of fat profit margin for a short period of time. So Walmart, along with the supermarkets, is hurting on the food side, in my opinion, when you put the detective hat on and you realize that they're actually getting helped, by not lowering the prices as much on the non-food side, and that's helping raise all boats.
You say 61% of retailers have higher operating margins than they did
the year before, which is remarkable.
They did have to take tremendous cuts, right? And 66% have higher gross margins than a year ago.
And it's going to be a lot higher for this fourth quarter. That's the third quarter. The fourth quarter is going to be a lot higher. This is really, I can't sort of say it enough how this is retail Nirvana for retail in a sense. I mean, operating margins are exploding. Sales are starting to go better than we expect.
Right.
That's sort of the wealth effect that's helping the higher end. Nordstroms and Saks are doing better because of the higher stock market. People are feeling better. And in essence, because inventories are low, that's going to really help, I believe, the global economy. There's going to be a lot more reordering than I think people expect.
So your bottom line is you're sticking with retail Nirvana. You believe
Oh,
this?
yeah. There's no question about it, at least in the near term.
All right. Thank you so much, David Berman, for joining us of Durban Capital.